Welcome to part 2 of our tax training, focusing on deductions and personal services income. Income tax is calculated on taxable income, which is assessable income minus allowable deductions. Deductions generally fall into two categories: general deductions, covered under Section 8(1), and specific deductions, like donations. For a general deduction to be valid, it must be incurred in the course of gaining or producing assessable income. It must also be paid from after-tax money, meaning you cannot claim items provided under a salary sacrifice arrangement. Furthermore, the expense cannot be capital, private, or domestic in nature, and cannot be used to earn exempt or nain income. Timing is also critical. An expense is incurred when paid or when a definitive obligation to pay arises. If an expense is incurred at a point too soon, such as studying to get a brand new job or paying for a relocation, it is not deductible. Substantiation is key to a valid tax return. If a taxpayer is claiming more than $300 for work-related expenses, written evidence must be kept proving the total claim, not just the amount over $300. Note that the $300 limit does not include claims for car expenses, overtime meal expenses, award transport payments, or travel allowance expenses. If an expense is small, under $10 each and up to $200 total for the year, a diary record is sufficient. A diary is also acceptable for undocumentable expenses, like coin-operated laundromats, and these do not count toward the $200 limit. Standard written evidence, like a receipt, must show the purchase date, item, date the document was prepared, supplier name, and value. These must be kept for 5 years. At item D3, we claim work-related clothing and laundry. Everyday, conventional clothing is generally not deductible, even if an employer mandates it, like a manager's business suit. We can claim clothing that fits into 4 specific categories. First is protective clothing, designed to protect from injury or illness, like steel cap boots, high-visibility gear, or sun protective clothing. Second is occupation-specific clothing, which distinctly identifies a profession, such as chef's pants. Third is compulsory uniforms that are distinctive and strictly enforced by the employer. Fourth is non-compulsory uniforms, but these can only be claimed if the design is registered in the Textile, Clothing and Footwear Corporate Wear Register. For laundering these eligible items, taxpayers can use the Commissioner's estimate, $1 per load for work clothes only, or 50 cents per load if mixed with private laundry. If the laundry claim is $150 or less, and total work expenses are under $300, written evidence of laundry expenses is not required. Item D5 captures other work-related expenses. Deductible items frequently include union fees, professional subscriptions, and tools of the trade. Sun protection is claimable for outdoor workers, provided the product has an ARTG ID number from the Therapeutic Goods Administration. Overtime meals can only be claimed if the employee received a bona fide overtime meal allowance under an award, and that allowance is included as assessable income. For the 2025 year, the ATO's reasonable amount is $37.65 per meal. It is equally important to know what cannot be claimed. Childcare expenses, general grooming, haircuts, and standard fitness expenses are private and non-deductible. Fines imposed by law are also explicitly non-deductible. Working from home claims are incredibly common. Taxpayers can use one of 2 methods. The fixed rate method allows a claim of 70 cents per hour worked. This single rate covers electricity, gas, phone, internet, stationery, and computer consumables. You can still claim depreciation on furniture and equipment separately. To use this method, the taxpayer must keep a record of their hours for the entire income year, plus at least one receipt demonstrating they incurred each type of expense covered. Alternatively, the actual expenses method involves calculating the exact work-related portion of every bill, like energy, internet, and phone. This requires a 4-week representative diary of usage and detailed utility bills. Note that standard employees generally cannot claim occupancy expenses like rent or mortgage interest, unless a part of their home is exclusively set aside as a strict place of business with no alternative provided by the employer. Moving to investment expenses, item D7 is for deductions against interest income. Taxpayers can claim account-keeping fees for cash management accounts, but these must be apportioned if the account is also used for private purposes. Item D8 covers dividend deductions. This includes interest paid on money borrowed to purchase shares, as well as ongoing management fees. Additionally, if an Australian resident receives a dividend from a listed investment company that includes a LIC capital gain amount, they are allowed a 50% deduction of that specific amount. Item D9 handles gifts and donations. A taxpayer can claim voluntary gifts of $2 or more to approved deductible gift recipients, or DGRs. Political contributions are also deductible for individuals up to a maximum of $1,500 per year. Remember, buying a raffle ticket or a charity pen is not a donation because the taxpayer receives a good or chance in return. However, special rules exist for fundraising dinners or auctions where partial deductions are allowed if the benefit received is under $150 and less than 20% of the contribution value. Item D10 is for the cost of managing tax affairs. This includes fees paid to registered tax agents, purchasing tax reference material, or buying tax software. Crucially, while ATO penalty interest has been historically deductible, from 1 July 2025, taxpayers will no longer be able to claim a deduction for ATO interest charges. Item D12 is for personal superannuation contributions. To claim this, taxpayers must have given their super fund a formal notice of intent and received an acknowledgement back before they lodge their return. For the 2025 and 2026 years, the concessional cap is $30,000. If a taxpayer's super balance is under $500,000, they can carry forward unused cap amounts from the past 5 years. Also, if the client is between 67 and 74 years of age, they must satisfy a work test to claim this tax deduction. Item D15 catches other deductions, predominantly income protection insurance. The premiums are only deductible if the policy replaces lost income. If the policy pays out a capital lump sum, like for death or loss of a limb, those premiums are entirely non-deductible. Finally, let's cover Item 14, personal services income, or PSI. PSI is income generated mainly as a reward for an individual's personal efforts or skills, commonly seen with subcontractors and labor hire arrangements. In a labor hire setup, the worker is legally employed by the labor hire firm, not the client they actually do the work for. A critical compliance point here: income from a PAYG payment summary, business and personal services income, must be entered at Item P1 and Item 14, it does not go at Item 1 with standard salary. Correspondingly, any deductions related to this income are claimed at Item P1, labels K and L, rather than your standard D1 through D5 labels. Note that occupancy expenses cannot be claimed against labor hire income. This concludes the comprehensive breakdown of deductions and PSI for the 2025 tax guide.